All right, everybody, what's up? It is Wednesday, March 30th. So we had a little pullback in the market today, and that should be expected. Like I said, this is going to be a slow upward move until it really starts to take off. Some interesting developments in this week's EIA, that's the Energy Information Administration's weekly petroleum status report. We saw that gasoline demand is finally starting to show some curtailment, some reduction. It's coming down. This was the third week in a row that gasoline demand fell. We saw distillate demand drop pretty sharply. Jet fuel demand was down, even though there's been reports of pretty robust travel. So we are starting to see perhaps the impact of higher prices on demand. Up until now, it really has been kind of sketchy in terms of showing any definitive demand reduction, but I think now we're starting to see that. Refiner inputs, that's crude demand on the part of refiners, that was actually up, so that bucked the trend, but that tends to lag. I mean, if you start to see product demand going down and inventories building up, and by the way, we did see an inventory build in gasoline, we saw inventory build in distillate, crude was a draw, we saw a draw in inventories in crude. All inventories are still very low. So I mean, I'm not trying to say that, you know, we're in a bearish environment for petroleum. We have very low inventories, but I am keeping track of that demand on the product side, and that is showing a little bit of softness right now. The other thing that I saw, which was interesting, was for the first time in 7 weeks, we saw an increase in U.S. domestic oil production. It was up 100,000 barrels a day to 11.7 million barrels a day. And like I said, that was the first time we have seen an increase. It's been flat, you know, for 7 weeks. We finally got a little bit of a nudge up. So I don't know if this portends, you know, the beginning of or a renewal of the uptrend in domestic oil production. I mean, we've definitely have seen rig counts go up, you know, operating rig counts, they have been going up, and I just kind of been very curious as to why we have not seen an increase in oil production, but maybe this is the first sign that, you know, we're going to reestablish that rising trend in oil production. Exports were weak. We had a decline in crude exports. We had a decline in product exports, and the U.S. is still a small net exporter. You know, I've been talking about that and why that is a factor that is mitigating the negative impact of higher oil prices on GDP. All right, when the U.S. is a net exporter, that adds to final sales of domestic product, and that offsets, at least to a small degree or some degree, the inflation discount or the reduction of GDP as a consequence of inflation. If the U.S. was a big importer like we were in the 1970s, see, I make this comparison because I think it's very important to understand. In the 1970s, the U.S. was a huge net importer of oil. So we had that double negative impact of high inflation and being a net importer. That was basically you're sending your income out to the foreign sector. That is a leakage to domestic income. It goes out to the foreigners, to the export countries. That's not the case now. We are a net exporter, even though a little tiny bit, but still we're a net exporter. And you know, in the 70s, you had a 4-fold price increase. So we're nowhere near that kind of a price increase now. As scary as the nominal price looks, you know, at whatever, $107 a barrel, we have not had a four-fold increase in the price. I mean, so conditions are significantly different now than they were in the 1970s. So I still say we would need much higher. I think we would need oil prices over $160 a barrel to even have, a strong negative impact on GDP. And we're not there yet. And again, I mean, if demand is softening now, which it looks like it is, then, that could be somewhat of an impediment to further price increases. But we'll see. Yesterday I said, don't get too psyched up about this talk about, Russians pulling back and a ceasefire and all this stuff. And today, the news anyway threw a lot of cold water on that Russia picked up its offensive in a different part of Ukraine. And I think this is all part of their military strategy. I mean, what they're doing is they are encircling and isolating the Ukrainian army in different regions of the country and slowly, tightening their encirclement of those areas. And it's just going to be a process over time where they degrade and take out these fighters and the Ukrainian military. And I know there's all kinds of Western media headlines about how the Russians are getting killed and they're getting their asses kicked and this and that. But this is this is their strategy. It is ongoing. They basically have Mariupol encircled. It's basically been taken over at this point. They're wiping out the Azov battalion resistance that is still there, but that's diminishing. And I mean, this is all part of the strategy. It's all part of the strategy. And I think the reduction in activity around Kiev was also part of the strategy. I mean, there's not much more that they can do there. And really what they're trying to do is secure that eastern part of Ukraine and areas where you have high concentrations of these Nazi fighters, these Azov battalions, and that is Mariupol, and that is in the Donbass region, and that's what's going on right now. So, I mean, I try to read alternative news sources, although it's getting pretty hard because a lot of those things have been blocked or, canceled. Taken offline, so it's difficult to find. But if you're just reading the Western news media, I think you're getting a false picture of what is going on. Anyway, this is not a geopolitical channel. I'm going to try to stick to the economics. I'm a little bit surprised, I have to say, that I was seeing a little bit of a slowdown in the fiscal flows toward the end of the month. Remember, I was saying we're looking at probably a 650 billion month in March. Right now, I have to be honest, and we got what 2 more statement days left. I mean, we'll get today's statement tomorrow, and then we'll get tomorrow's statement on Friday. It doesn't look like we're going to hit the 650 billion. We'll probably get maybe around 600 billion. Still not a bad month. I mean, that's a significant month. February was 606 billion. If we end up with 600 billion, the thing is, where I'm a little bit concerned is that these February and March are the 2 biggest months when it comes to fiscal, because these are the months that you have the IRS tax refunds that flow out in the biggest quantities, all right? Once you get into April, that's tax season, and then the rest of the month will fall back into more or less a regular monthly flow rate, and that could be, in the low 500 billions, maybe around 500 billion. Now, again, 500 billion would still be a 25% increase in the fiscal flow over what we saw in the pre-pandemic period. That is basically throughout the entire Trump presidency, when we were running about 425 billion a month average. So 500 billion is still nothing to sneeze at. It just means we're going to see slower rates of economic growth than we saw at least up until now. And again, first quarter, you know, they're looking at something like 1.5, maybe 1.5 to maybe 2%. So it's going to be close. It's going to be close with the inflation aspect. Fed is going to raise interest rates in May, okay? And rate hikes, let's set aside what could be the initial negative reaction by, you know, people freaking out and selling stocks because the Fed's maybe going to raise probably going to raise 50 basis points in May. But again, and I've said this many times, this is like a real-time laboratory where you're going to see, or we will see, the real impact of rate adjustments. And what I've been saying is that rate hikes equate to fiscal expansions by virtue of the fact that the government is a net payer of interest, and when the Fed raises rates, then necessarily the government's going to pay more interest. It's going to flow into the economy. That's more income added to the economy. Now, again, it's not equally distributed. It's not like a fiscal stimulus where they're handing out checks to everybody, but you can't be negative when there is income flowing into the economy, net income flowing into the economy. You know, that gets spent and that adds to GDP, and it is an economic support. It is not negative. But look, we're going to see this in real time. I mean, we're still we're March 30th right now. We got to wait till May 16th, and then through the rest of the year, they're going to be raising interest rates every single month, and this is going to be a gradual thing. But we have this real-time analysis, this real-time laboratory. It's not about conjecture or theory or what we think is going to happen because we believe that rates hikes automatically are negative. No, we have a logical understanding now, a rational understanding of what it actually means. Okay? I've said it many times. Try to understand what rate adjustments mean. They're price adjustments, and they're either the addition or subtraction or reduction of income flows, of fiscal flows to the economy. I mean, you have to really break it down so you don't get, you got to break it down in its most basic terms and the real understanding of what it is, because otherwise it's very easy to get influenced and get freaked out by all the hysteria and the mythology that surrounds this stuff, because that is out there, pervasive everywhere. And, you know, it's just pushed and pushed and pushed, and people buy it because it sounds plausible, it sounds logical, but it's not the way it works. And we're going to see it. I'm telling you. I mean, we still have a long way to go before the evidence is before us, but I'll come back to this at some point, you know, later on this year. We will come back and we will revisit this discussion and this lesson, if I can call it that, of what I'm trying to explain here. We'll come back and we will revisit this, and the evidence will be very clear. Now, of course, those who continue to push this mythology, they will come up with some way to rationalize why their forecasts and everything else did not work out. I mean, that's always true. All right, whenever these things don't work out in the way that, you know, this belief system says it should, and I'm talking about the mainstream economics belief system, they always come up with some rationalization of why it doesn't work out. But as I've said so many times, you know, lack of understanding lack of knowledge, of information, presents opportunity. I mean, you know how people are going to behave. And based on that behavior, that presents opportunity to you. So like today, when the market was down, I mean, at its lowest point, and I sent out an email, you know, saying you got to buy that dip. That is the strategy right now. Now again, I'm going to be paying close attention, as I always do, to the fiscal flows, because that's the key. But I would also add, as I have been saying now for weeks, also focus on what's happening with bank credit. Bank credit is a very important and powerful element, just as the fiscal, in, you know, what goes into the economy and the support that is given to the economy. And bank credit now is expanding, and actually, if we finally see the Fed start to reduce its asset holdings, if we finally start to see them reduce their balance sheet, and we see reserve balances brought down, I mean, this would be a key development. And people, you know, they talk about this as quantitative tightening. Let me say this: there's no such thing as quantitative easing, and there's no such thing as quantitative tightening. Both of these things, they're neither easings nor are they tightenings, okay? All they are the recomposition of dollar assets in the economy. There's no change in the aggregate amount of dollar assets in the economy. One, a QE, that is just more bank reserves and less government securities. A QT tightening is just more government securities and less bank reserves. Both are dollars. Government securities are US dollars with a term and a coupon. That means they have a duration, you know, 1 year, 2 years, 5 years, 10 years, and a coupon means they have an interest rate. Okay, so there's no such thing as QE. It's neither an easing nor a tightening. All it is a recomposition of the dollar assets in the economy, and it does not affect the total level of dollar assets. It's just a change in the composition of those assets. So I mean, let them call it a tightening. I'm happy when they call it a tightening, because to me, it's funny, number one, it's comical. They don't understand what it is. And actually, if the Fed reduces those cash balances, it just gives the banks more room on their balance sheets to add other assets like treasuries, like loans. That's not a bad thing. That is not a bad thing. So I'm waiting, you know, in anticipation for when the Fed does this so-called tightening, because this would be a very positive development for bank credit and the expansion in bank credit. And, you know, I want to see that happen for two reasons. Number one, like I said, fiscal is, you know, it's declining relative to last year. So we like to see a little bit of an offset to that, or something to come in to help. And bank credit is the thing. Of course, bank credit can't go on forever like fiscal can, but right now, I think to have that would be a very welcome addition. And we are getting that. We are getting that. I've been talking about that. The expansion in bank credit, the expansion in loans and leases. So let them do the tightening. I'm waiting for them to do the tightening. That'll be a very positive development. And that's another real-time laboratory we're going to have when they all do the tightening, and it doesn't result in, you know, like a recession or a collapse in the economy or the stock market. Again, they're going to be rationalizing. They're going to have to come up with a way to explain why their theories didn't work out the way they said it was going to work out. We'll see. We'll see. We're going to come back to these conversations down the road. I'm sure of it. And We'll see who's right. We'll see who's wrong. Anyway, that's it for today, folks. Hope you enjoyed the day, and see you tomorrow. Bye.